Hey everyone, welcome in to another daily editorial here on the KE Report. We're chatting with Jordan Roy-Byrne, founder and editor of The Daily Gold. Now, Jordan, again, a little focus on the precious metals here. Gold is down today, silver is down today, pretty much everything is down. And really, in the last hour or so, even the US markets have broken down. This is still in the environment where the dollar is up, albeit still just holding around these higher broad levels, and rates have moved higher again. The 10 years over 4.1% right now. Focusing on the resource sector, though, especially precious metals, it was a couple weeks ago at the start of October. A lot of people were saying there was a bear trap when gold broke below 1675 and GDX and GDXJ broke down, and then they pretty quickly reversed. That reversal lasted a couple weeks, and now we're heading back lower. Gold, GDX, GDXJ, even silver, not back at those lows we saw in around mid or late October, but boy, oh boy, we are sure getting close. Jordan, your takeaway from what seems like that false call of a false breakdown for gold now that everything has reversed back lower?
Yeah, I mean, when a market is trying to make a bottom like that and then it fails, there's probably, or there can be another leg down. It doesn't necessarily have to be a big leg, because if you're looking at things like the advanced decline line, the percentage of stocks making new lows, there are some positive divergences there. And I mean, you can have a positive divergence hold up for 2, 3, or 4 months, before the market makes a final low and turns around. So, I mean, you think about that, and you think about, gold is pointing lower. You have really strong support in the mid 1500s. Looking at sentiment, I mean, sentiment indicators are not quite at extremes yet, but they're pretty close. So I thinking, in my mind at least, the scenario of let's see what happens if gold comes down to that really strong support in the mid 1500s. Let's see where the sentiment indicators are at that point. I mean, maybe they will be at truly extreme levels like we saw at the 2016 bottom, the 2018 bottom. So that's a scenario I'm thinking about. But I mean, at least for the stocks, it's good to note that the internals now are showing these positive divergences. So I wouldn't be dissuaded if we see miners continue to trend lower. I think I think if they make a lower low, that's when you want to get pretty aggressive on the bullish side, because I think fundamentals are going to come into line shortly. I mean, I've definitely been wrong about the Fed pivoting sooner than people were thinking. That hasn't happened yet, but even in the scenario, like, let's just presume they're able to hike in November, which, I mean, looks like they are. And then in December, I mean, that's likely to be the last hike. There's even Wall Street people saying, they would, after that, they would pause. Because, I mean, if they were 4.5%, that's fairly high that they could pause. And so you're at this point in time, if December is the last hike, you're already really, really close to the end of the hiking cycle, that at some point the market fundamentally is going to start discounting the end of the hiking cycle. And I don't know if that, when that will start, but I don't think it's that far away. In other words, if December is the last hike and we're sitting here a month from now, you're pretty close to the last hike. Like, you're roughly 4 or 5 weeks away from no more hikes. So if you think about that fundamentally, how close we are to the end of the hiking cycle, and then you think about the technicals and sentiment and where things could go shortly, you have the setup for a major bottom here. So I think we're setting up for that in the next month or two.
Well, Jordan, the sentiment is pretty rough out there, and a lot of people didn't even want to see gold get out of the 1700s, much less get in the 1600s and then head down into the mid 1500s. Same thing with the mining stocks. They've really continued to break down, and I think it's zapped a lot of people's energy What do you think will cause, besides the Fed stopping hiking, is there anything else that'll cause the divergence where we'll start seeing the precious metals gain a little luster back in relation to the other markets? Because, like you've mentioned for a while, for it to be a real bull market, we need to see the precious metals gaining on other sectors. Is there anything else on the horizon that you see as a catalyst, fundamentally, macroeconomics, that would get things moving besides just the Fed stopping hiking?
The economy getting worse. I mean, it's that simple. The economy getting worse and recession becoming a bigger issue than inflation. I mean, at times in recent months, it looked like that was about to happen. I mean, I don't know. Maybe after the November elections, the politicians start talking about the economy a lot more than inflation. Maybe economic data gets worse. I mean, it hasn't gotten that worse yet. I mean, hasn't gotten clearly worse enough yet. But I think that's really that's the answer to your question. And markets sniff these things out before we can predict them, but clearly the market hasn't sniffed that out yet. It's still 100% focused on Fed hiking, and of course the dollar's moving higher, and so that's keeping pressure on the bond market, and so long-term yields are going higher. So we haven't seen the shift there, but that's, again, I mean, we can think about reasons and answers, but the market will sniff these things out before. But that would be my guess, is something to think about. The market getting more or thinking or discounting more in the way of there's a coming recession versus inflation is still a problem. The Fed is still going to be hiking. So I think, but I do think the market in the next couple months will probably sniff that out. And at the same time, you'd see the bond market. You'd see probably a subtle shift there where like the 10-year yield starts coming down before the Fed stops. So that's something I'd look for in the next couple of months here.
Anything else outside of the bond market that you'd be looking for? Because you are right. Markets are forward looking. Fact of the matter is, markets continue to move down, rates continue to move up. Is it just the bond market you're going to be focused on then?
Yeah, I mean, basically, that's one big focus in addition to just looking at the price action of everything. But yeah, going back to the question, it really is economic weakness and recession. I mean, the more that becomes an issue, that's when precious metals will really strengthen and outperform. I mean, recently after the inflation print, precious metals for a little while, it looked like they were diverging. They were showing good relative strength. And in a short-term sense, they've fallen off in the last week or two in real terms because you had that strong core inflation print. And, the market's takeaway from that is, okay, policy has to continue to tighten. And there was nothing about, growth slowing or recession concerns. And so in that kind of scenario, you'll see stocks and commodities perform better than precious metals. But I do think eventually it's only a matter of time here in the next couple months when the focus is going to turn to economic weakness in the coming recession. And of course that coincides with the Fed stopping. It's just we're not quite there yet, and I've been wrong about that. But I see that shifting, before we get into January.
Well, Jordan, you brought up the commodities there, and you had mentioned off mic that you've been looking at some of the relation to just the commodity sector as a whole versus the general stock markets. Any thoughts there?
Well, yeah, this is a big picture point that's important. If you look at any commodity index where the weightings are they're pretty equal across the board, and I'm not talking about the CRB, which is a really and that factors in having to roll the contracts into the next month, the cost there. So the CRB is not really a good indicator of long-term commodity prices. I mean, they messed up that basket in 2005 when they changed it. I mean, remember, like 5 years ago or so, there were people who were, thinking they were looking at the CRB and thinking we're going to have this massive deflation, and so they were getting the wrong takeaway from the messed up chart. But if you look at a equal weighted basket. Like if you look at the Bloomberg spot commodity index, that's one, that in the last year or two, whenever it was, that I don't have it in front of me, but that broke out to a new all-time high. And basically every time that happens, you're in a secular bull market for commodities and you're in a secular bear market for the stock market. Again, I'm sorry I don't have the chart in front of me, but you can see that when it's made these breakouts, those have clearly been periods in which commodities had another 7 to 10 years of upside, and at the same time the stock market was in a secular bear. And so that's, I believe, we're like in the first inning of that. When you look at the stock market, it's lost the 40-month moving average. I mean, it may have a bit of a rally here. Maybe it has a half decent bear market rally and it goes to 3,900 or something like that. But stepping back, looking at the history and thinking about this bear market where the S&P is already down, I think at its peak it was down 28%. It's pretty clear with what the Fed's doing, the coming recession, the fact that corporate profits have not really come down that much yet. I mean, there's the setup where this bear market's going to continue. There's going to be another lower in that scenario. I mean, that is reflecting that we're in a new secular bear market, in my opinion. And so looking at commodity prices, that's just another strong indicator or hint saying, hey, commodity prices have broken out to a new all-time high, at least this spot index. And yes, it can pull back for a year or whatever, but that's the breakout and the new all-time highs, that happens in secular bull markets for hard assets. And that coincides with a secular bear market in the stock market. So, I mean, that's a really good setup for commodities over the long term, but also precious metals. We know that precious metals will lead. And so precious metals are going to lead out of this bear market and recession. But they typically start moving and performing before the end of the bear market and well before the end of the recession.
So what are you looking for in terms of the resource stocks then? Again, looking ahead to when a turn might happen, is it going to be the majors, the larger companies that lead that charge? Are you looking for increases in volume, although I know you don't like following volume that much? What is going to give you a sign that finally we might start to see a sustainable uptrend?
Well, I want to assess everything. If we see, gold's trading at 1633 now, I think it's going to come down to that major support in the mid 1500s. So we'll see where the net speculative position is, because that's been my bugaboo, at least over the last, 2, 3, 4 weeks. The last time gold, I think at the end of September when it got down to 1620 or wherever, the net spec position came down to about 13% of open interest. It was around zero at the 2016 and the 2018 lows. And I think at the last reading, it was at 20% or 23%, something like that. So so even though sentiment is really bad, there's still too many speculators in the gold market. I mean, given how bad sentiment is, you would think that there wouldn't be, that many spec positions in the market or speculators left, but there are too many, unfortunately. And so we need all those people to sell, excuse me, I think, before gold is going to hit that low and turn around. So I'm eager to see if I'm right and gold's going to continue down here to the mid 1500s. Where's the sentiment going to be at that point? Where are these public opinion daily sentiment index? I mean, they're already pretty close to extremes. I do think they're going to be at extremes at that point. And I think that the net spec position could be pretty close to zero. So that's what I'm looking for. I mean, and this is what should happen and I think will happen. You see gold come down to really strong support. You see these sentiment indicators get really blown out. And so gold should bottom before it becomes apparent to everyone that, the Fed is going to pause and that they're done hiking. So that's what I'm looking for. I think if we're all going to wait until the Fed officially pivots, I think by the time that happens, gold, when it becomes official that the Fed says, oh, we're pausing our rate hikes, gold will probably have already rallied to that point, and then gold will have a big rally after they say that. But I don't think I don't think you should wait till that happens. I think that seeing, it's kind of counterintuitive, but seeing gold break down and make a new low, seeing GDX and GDXJ break down and make a new low, especially if the internals remain strong. I mean, to me, that's setting up a strong buy signal and potential for a major bottom. So I'm looking for those things as far as technicals and sentiment. I think the macro is going to come into a favorable point for precious metals pretty shortly, but the technicals, those things are they should line up before the macro picture clears up.
All right, Jordan, we'll wrap it up here. Thanks for some of these insights. What we can look to hopefully see a turn in these precious metals markets, because it's been a tough market for them, and it's been interesting over the last couple of days. We've had a lot of other commentators say that they're almost reevaluating some of their narrative on gold because of all the different macro factors that we thought should have been driving gold higher don't seem to be right now. Jordan, thank you for your time. We'll chat next week. Have a great rest of your week.